Good day. Welcome to another session of Fog Accountancy Tutorials. Today we continue our lesson on consolidated statement of financial position. We are going to take a question that is going to cover the forms of purchase consideration that we explained, and also how to prepare the net asset list in order to ascertain the post-acquisition profits. Now, what we are going to do is that after this, we are going to talk about intra-group adjustments, which will be the last aspect of the consolidated statement of financial position. We'll talk about the intra-group adjustments and unrealized profit and all that. But then the question that we are going to solve today has an element of intra-group adjustment, which I'm going to explain per the requirements of the question. And then afterwards, I'm sure that we'll be good to go with the statement of financial positions consolidation. So without wasting my time, I want to read the question straight away so that we'll be able to solve that together. Okay. Goodwill Brewery Limited, GBL, acquired 2 million equity shares in Ayomso Brewery Limited, ABL, on 1st January 2013, on which date the retained earnings of ABL stood at 300,000 Ghana cedis. The agreed consideration was 1.5 million cash and a further 600,000 Ghana cedis on 1st January 2015 if ABL attained certain profit targets. So that is a contingent consideration. We move on. GBL's cost of capital is 15%. The draft statements of financial position of GBL and ABL on 31st December 2013 were as follows. So we have, for GBL and ABL, we have the non-current assets, PPE for 2,500. You have 3 zeros up, of course, so that is 2.5 million. And then 2,000, which is 2 million for ABL. For investment in ABL as cost, mind you, there are 3 zeros up, so 1.5 million. And then, under current asset, we have inventory 150 and 400. We have receivables 800 and 350. And then we have owings by GBL under ABL alone. That is 500 Ghana cedis or 500,000 Ghana cedi. I'm going to explain that. And then we have cash and cash equivalents for GBL 100. Then we move to current liabilities. We have owed to ABL, that is 400. And then we have trade payables 500 for GBL and 350 for ABL. And then giving us a net asset of 4,150 and then 2,900 respectively. Then we come to equity. We have stated capital, ordinary shares at 50 pesos, that is 0.5 Ghana cedis each. 2,250 for GBL, 1,250 or 1,250 for ABL. And then we have the revaluation surplus to be 600 for GBL, 250 for ABL. And then finally, the retained earnings of GBL, 1,300. And that of ABL is 1,400. Still bearing in mind that we have 3 zeros up. So that is a 1.4 million. Okay. Then we move on to the additional information. ABL has an internally developed brand, Aboso, which was valued at 250,000 Ghana cedis at the date of acquisition. There have been no changes in the share capital or revaluation surplus of ABL since GBL gained control. At 31st December 2013, ABL had invoiced GBL for transfer of malt, a basic raw material for brewing, to the value of 100,000 Ghana cedis, which had not been received by GBL. There is no impairment of goodwill. It is the group's policy to value non-controlling interest at full fair value. At acquisition date, the non-controlling interest was valued at 450,000 Ghana cedis. Required. Prepare the consolidated statement of financial position for GBL Group as at 31st December 2013. Okay, so this is the question. A very interesting question. Now, what I want us to look at from this question, let us pick up some very important points from the question, and then we'll start solving. We are told that the GBO, which is the parent company, acquired 2 million shares in ABL on 1st January 2013. So what I want you to note is that the acquisition date, these are things you should consider. That is why I'm putting them down. The acquisition date is 1st January 2013. Now, what is the reporting date? We are told that the draft statement of financial position of GBO and ABL on 31st December 2013. So the reporting date is 31st December 2013. So you see, this reporting date is what we are going to consolidate. And this is a question of post-acquisition date consolidation. All right. And we also know that there has been 1 year since its acquisition. So whatever statements we are coming to prepare now is after 1 year of acquisition. Bear that in mind because it's going to help you in a lot of things. Then we are also told, let's look at the purchase consideration. We are told that on which date, first of all, they acquired it, on which date the retained earnings of ABL stood at 300,000 Ghana cedis. So on the date of acquisition, the income surplus balance of the subsidiary was 300,000. That is on the date of acquisition. The income surplus balance at that time. And this 300,000 is what we are going to use for the calculation of goodwill. Because we know that for everything we are going to do, one thing is exceptional. The calculation of goodwill is done at acquisition date. And so at acquisition date, the income surplus balance of the subsidiary is 300,000 Ghana cedis. And that is what we are going to use for our calculation of goodwill. Then we are told that on the reporting day, look at the statement of financial position of the subsidiary ABL. Under the equity column, we have retained earnings of 1.4 million, 1,004. So it means that at reporting date, the same income surplus balance has increased from 300,000 to 1.4. And it tells us that even though the parent company bought it at a time when it was 300,000, now it's 1.4. So they have worked to add up an additional 1.1 million, which will be considered as a post-acquisition profit. But remember that I told you that don't be too quick to conclude that the post-acquisition profit is just by comparing the income surplus or the retained earning balance. You need to consider other items on the net asset list to see if there was any movement. And that is why we are going to prepare the net asset list to that effect. But I want to draw your attention to the fact that this is an increase. And so the parent company has a share only in the post-acquisition income surplus. All right. Now let us continue to pick up other important things from the question. We are also told that the agreed consideration was 1.5 million Ghana cedis in cash and a further 600,000 Ghana cedis on 1st January 2015 if ABO achieved or attained certain profit targets. That is very, very important. Now, the date of acquisition is 1st January 2013. Now, you are paying an initial cash for 1.5 million. This is the terms of the purchase or the cost of the investment or what we call the purchase consideration. So for the cost of the investment or the purchase consideration, we have 1.5 million Ghana cedis in cash, which is going to be paid by GBL to ABL. Then there is a deferred and contingent. Now, I call it a contingent consideration because there is a condition attached. Okay? They will pay a further 600,000. This will be paid on the acquisition date, which is 1st January 2013. Make no mistake about that. It says that you are paying cash of 1.5 million. This one will be paid on the date of acquisition. But a further 600,000 Ghana cedis on 1st January 2015. From 1st January 2013 to 1st January 2015 is a 2-year interval. Okay, and so that is a deferred consideration. But there are some conditions attached. It said that if the subsidiary is able to achieve certain profit targets, so this is a contingent consideration. And because it is going to be paid in 2 years' time, we are going to need the figure or the value of this 600,000 in today's term, as at 1st January 2013, which is 2 years back, in order to allow us to calculate the purchase consideration to find our goodwill. And that is where we are going to do the discounting of this 600,000. Like I taught you in our previous video, we'll discount it back into 2 years back to the date of acquisition, which we are going to use to calculate our goodwill. And we are going to use the cost of capital given to us. We are told that the company's cost of capital is 15%. So you see, all these things that I am picking out for you are so important that they are things that you should consider in trying to analyze a question of this nature. All right. So you need to, I am picking them out like this. But whenever you are reading a question like this, you need to take your time and do all these analysis that I'm doing very well before you even approach the question. Other than that, you will not be able to get what you have to get right. Okay. And then we have the various statements of financial positions of the parent and the subsidiary. So we have PPE, which we are going to consolidate. Then we have investment in ABL, shares at cost. You see, now there is a change. You can see from the question that we have investment in ABL shares at cost to be 1.5 million, which is 1,005 with 3 zeros up. Now, it means that on the statement of financial position, they have only captured the cash consideration. They did not capture the total consideration that we are going to pay, because this is a contingent consideration which was not captured. And so in this case, you cannot say that because they put 1.5 million on the statement of financial position, that is the only purchase consideration you are going to use. Remember that what is in the introduction supersedes what we have in the statement of financial position. So yes, we see 1.5 million in the statement of financial position, but we are supposed to also take into consideration the contingent consideration. And that is very, very important. So that is it. Then we continue to analyze. Under the current asset, we have inventory, we'll consolidate. We have we have receivables, we'll consolidate. You add the two. Then we have owings by GBL, 500,000. If you go to current liabilities, you will see owings to ABL, 400,000. Both are not the same. Now, this aspect that you see here is supposed to be for intra-group adjustments, which I will treat after this video. Okay, I'm going to talk about intra-group adjustments after this video. But once it has appeared in this very question, we need to talk about it. What we normally say is that when we are consolidating the financial statement, the two different entities, the parent and the subsidiary, is supposed to be seen as one entity, a group. And because it's supposed to be seen as one entity, I cannot owe myself and I cannot be owed by myself. Okay, so whatever amount of money that the parent owes the subsidiary or the subsidiary owes the parent should be cancelled out. It shouldn't come into the consolidated statement of financial position. And so you see this owings by GBL that we have under current asset of ABL. It means that GBL, which is the parent company, has either taken some cash or goods that they have not paid from the subsidiary. So they owe them. So they have to show that as an asset. And then if you look at the statement of financial position of the parent, they have also disclosed that they also owe the subsidiary. So those two figures should just be cancelled out. That is the normal practice. It shouldn't appear anywhere in the statement of financial position consolidated. So when we are consolidating, that will not appear, this will not appear. So that is just like the cancellation I taught you in the case of goodwill and the equity of the parent. But there is an exception here. You could see that in the current assets of ABL, they have showed 500,000 as being owed by GBL. And then GBL is also showing 400 as being owed to ABL. So there is inconsistency in the figures. This person says you owe me 500. The other one says I owe you 400. So what is the difference? The difference of 100. Now, what could this be? We cannot cancel out 400 and 500. If we do that, the statement of financial position that we are going to consolidate will not agree. So what we need to do is that we can only cancel out 400 and 400. That means there will be a remaining 100 that will be left under the current asset of the subsidiary, which is supposed to be either cash in transit or goods in transit. So that difference of 100 is supposed to be either cash in transit. In other words, it means that it's either the parent who is owing the subsidiary has actually paid the cash. They have remitted the cash, but the cash has not yet reflected in the accounts of the subsidiary. And because they have not yet received it, they have not cleared that they have paid 100. and that because the parent has actually paid, they have reduced their debt by that 100 to make it 400. That could be a possibility. Another possibility could be goods in transit. It could be that the subsidiary has remitted an amount of a value of goods, or has transferred goods to the parent, and they have also added that they have sent goods to the parent to a value of 100, but the parent has not yet received those goods. So we call that goods in transit. Now, whatever the case will be, whether goods in transit or cash in transit, both of them will stand. But the actual figures, the 400 should cancel out with the 400, and the extra 100 will stand in the consolidated statement of financial position. If it is cash in transit, it will be added to cash and cash equivalent. If it is goods in transit, it will be added to inventories. And that is how we are going to look at that. So when I get there, I will explain again. So the next thing we should look at, I think there is nothing much more to look at. We have the cash and cash equivalent to be 100 for only the parent. There is none for the subsidiary. And you see, let us look at the stated capital also. There is something to also pinpoint from there. Now, we are told that stated capital, ordinary shares, at 50 pesos per share, that is 0.5 Ghana cedis per share for both companies. So we are going to use that to know the total number of shares. Remember that we are told in the introduction that GBL acquired 2 million equity shares in ABL. Okay, so they didn't tell us the total number of shares of ABL at the date of acquisition. We are only told that they acquired 2 million. So in order to know the percentage or the cost of control, or what we call the group structure, in order to know that, you need to find the total number of shares, and then you find a fraction of that to get a percentage that has been purchased by the parent. And then you are going to use this 50 pesos per share as a basis for finding that. So let us take note of that. We also have the revaluation surplus for both, and then retained earnings. Now let's quickly look at the additional information, and then we'll be good to solve the question. Additional information. ABL has an internally developed brand, Aboso, which was valued at 250,000 Ghana cedis at the date of acquisition. Now, this internally generated brand was not in the financial statement, but we were told it was there on the date of acquisition, and it is still there because we are told it has, not it had. The tense of the sentence makes us understand that the internally generated brand is still there. Okay, 250,000. Now, it was there at the date of acquisition, and so it should be part of our net asset list at both acquisition and then at consolidation date. Now, because it was not in the financial statement, when we are preparing the consolidated statement of financial position, we must capture that as well. It's very, very important that it should be captured now in the statement of financial position. So take note. Then we are told there have been no changes in share capital or revaluation surplus since the control was gained. So it means that at acquisition date and at reporting date, there has been no changes in both the stated capital and the revaluation surplus. So, but the income surplus has definitely changed. We could see that. All right. As at 31st December, ABL had invoiced GBL for transfer of malt, a basic raw material for brewery, at the value of 100,000. Okay, so that is what I was talking about. This is the 100,000. That is the difference between the owing by GBL and the owing to ABL. So that is a goods in transit. We are told that this particular difference of 100 is goods in transit. So we are going to treat it as part of inventories in the consolidated statement of financial position. And then, finally, we are also told that there is no impairment of goodwill. So then it is the group's policy, finally, it is the group's policy to value non-controlling interest at full fair value. At the date of acquisition, the non-controlling interest was valued at 450,000. So that is the full fair valuation at the date of acquisition, 450,000 Ghana cedis for the non-controlling interest, or the NCI. And I have taught you already how to treat that. We are going to show that, we are going to add that to the purchase consideration of the parent to get the total cost of investment in order to find the goodwill at acquisition date. It's very, very necessary, and it's going to also change the way we find our non-controlling interest value as reporting date. So this is just the analysis that I want us to look at, and then we will be good to now solve the question. Okay. Let us now solve the question together. Now, the first thing that we have to do is, I told you, let's find a group structure. Once we follow those procedures, we have no problem. So, the first workings, let's do our workings first, is to find the group structure, working one, or the control structure. Now, the group structure, according to this question, we are told that the parent, GBL, bought 2 million equity shares in ABL. So 2 million. But then we don't know the total number of shares of the subsidiary. But we are told from the question that it is the total share value in cedis, 1.250 million or 1,250. So 1.250 million. And then the price per share is 50 pesos. So to get the total number of shares of the subsidiary, which is ABL, is going to be 1,250,000 divided by the share price of 50 pesos, which is 0.5. And that is going to give us 2.5 million shares. So the total number of shares of the subsidiary is 2.5 million. And so in order to get your group structure, you see that the parent acquired 2 million shares all over the total number of shares, 2.5 million, times 100. And that is going to give us 80%. And so what we are trying to say is that the parent, or GBL, acquired 80% shares in the subsidiary. So you see the trick that it wasn't given to you straightforward. You have to even go through this process to find the total number of shares. So if you are not able to establish the total number of shares, you'll be stuck from the first start, because you can't even find the group structure. And if you cannot find the group structure, there is nothing more you can do. So very, very important. And if the parent has 80% holding, then it means that non-controlling interest, or NCI, will have 20% holding, giving us a total of 100. And this is the first working that I always tell you to do, to find the group structure. Very, very necessary to find the group structure. So now that we have found our group structure, the next thing to do is to go to the calculation of goodwill. I told you that the big four, we have the group structure, goodwill at acquisition date, then we have the NCI as reporting date, and then the group or consolidated income surplus as reporting date. But to get these four, sometimes you may have to go through other things. So the next thing we have to look at is the goodwill. But we cannot find the goodwill at acquisition date if we have not been able to establish the total purchase consideration, which is going to be made up of the cash consideration and the contingent consideration. So that is the next thing we have to look at, the calculation for purchase consideration. And also, we are also going to do the net assets list at once, so that when we are moving, we just move straight to the other three in the big four. So let's do the purchase consideration calculation. We will do the net asset list, and then we can proceed to continue from goodwill and then the rest. So let's look at the workings for purchase consideration, or the cost of investment. The purchase consideration or cost of investment of the parent. Okay. So we are told that we have the cash consideration to be 1.5 million. Let me put 3 zeros up. Please permit me to show my 3 zeros up so that I can write here 1,500. Very important. And then we also have a deferred or a contingent consideration. And the contingent consideration is going to be discounted. So we find the discounting factor. So it's going to be 600,000 that we are supposed to pay times the discounting factor 1 over 1 plus the cost of capital of the company is 15%, 0.15. Now it's going to be raised to the power 2. It's going to be raised to the power 2 because it's going to be 2 years. You can find this from your present value table and then put the figure there straight away. Okay. If you look at this from the present value table, it's going to be 0.756. So you multiply 0.756 by the 600,000. Please and please again, you need to understand the time value of money very well before you can do this. So you need to understand how to do future values and then present values. Very necessary. So once you're able to discount this, then you get a figure which is going to be 453.6. Okay, 453.60. So when we add that up, we are going to get total purchase consideration of the parent to be 1,953.60. Bearing in mind that we have 3 zeros up. So this is how to get the total purchase consideration at acquisition date. And then we are going to use this to calculate the goodwill. This figure will be our purchase consideration, not only the 1.5 million. And I taught you this in the previous video. And then after that, let us also try doing our net asset list. Now, we can do the goodwill before we do that of the net asset list. But I want us to do that at once and then we can continue with the big 4. So the third workings, I'm going to call it net assets list. Now, very, very important. Pay attention to what I'm coming to do. In every question that you do, you make sure that you do this before you proceed. Once you get your cost of control, find your purchase consideration. Make sure you are doing the net asset list before you proceed because it's going to help you in a lot of things. Now, the net asset list is supposed to be shown at acquisition date and then at reporting date. The reporting date is the date that we are consolidating, which is 31st December 2013. That is 1 year after acquisition. And the acquisition date is 1st January. Now, instead of writing as reporting at acquisition, you can just put in the dates, and that will be acceptable. So you can either write here 1st January and then 31st December 2013. That is also acceptable. Now, we are going to list our net assets at both dates. Let me put my Ghana cedi sign and then let me also bring up 3 zeros so that we know that we are working in millions, but we are going to write them in thousands. Okay. Now, let us consider the stated capital first. Remember that we are looking at the net assets in relation to equity, I told you. So with the stated capital, and please, we are looking at the net asset list of the subsidiary. So let me also add that before you go and pick any figure of the parent. We are not bringing in any figure for the parent. This is net asset list of the subsidiary at acquisition date and at reporting date. Now, at acquisition date, the stated capital of the subsidiary is 1,250,000. We are told that there was no changes. And that means that at reporting date, it's also, actually, this is what we even have at reporting date. But we are told there were no changes, meaning that it was the same at acquisition date. And then also we have the revaluation surplus from the statement of financial position. We have revaluation surplus at the acquisition date to be 250. And then the same for reporting. Actually, the statement of financial position that we have is at reporting date. But we have been told in the additional information that there were no changes. If there were any changes, it would have been mentioned. So we always assume once they didn't say anything about that, then there are no changes in revaluation surplus. So at acquisition date is 250, at reporting date is 250. And then let's look at the retained earnings. We are told from the question that the GBL bought ABL. So that on which date retained earnings of ABL stood at 300,000. Okay, so at acquisition date, the retained earnings, which is also known as the income surplus, stood at 300. But at reporting date, which is the statement of financial position we've been given, we have seen that it is 1.4 million. So the statement of financial position that we have been given is what is catering for the reporting date. The acquisition date, we are told about them. So that is it. So at acquisition date, we had the income surplus balance to be 300, and then at reporting date is 1,004. This is what we saw from the statement of financial position. But let us not forget that we have been told about a certain brand. We are told that ABL had an internally generated brand, Abos, which was valued at 2.5 at acquisition date. There have been no changes in the share capital or revaluation surplus. Now, listen very carefully. You can say, but what is brand coming to do together with these items of equity? Remember that the brand name is an intangible non-current asset. And once we are introducing it into the asset, then it has to affect equity as well. Because according to the accounting equation, asset equals to equity plus liability. So if you are increasing the asset by 250, you have to either increase your equity or liability by the same 250. And we know that this brand name will not be a liability. So definitely it is supposed to be part of equity. And that is why we are listing net asset list. It is, when we look at it from this side, it's part of net asset. When we look at it from the point of equity, it should also be part of the net asset. And so we are going to have brand name. And we are told it was there at acquisition 250. At reporting, it is still 250. There has been no impairment of that. And ladies and gentlemen, this is our net asset list at acquisition and that at reporting day. So we find the totals. You will see that the total net asset at acquisition is 2,050. And then the total net asset at reporting days is 3,150 Ghana cedis. So you see that there has been an increase. So we have to find the difference. So we now find our post acquisition profit. And post acquisition profit is going to be 3,150 minus 2,050. So we are actually finding the difference between the two to see if there has been an increase in the reserves or the net assets. And truly, the increase is going to be 1,100 Ghana cedis. And that is going to be our post-acquisition profit. And this is what we are going to use. Remember that the non-controlling interest will have a share of this, and then the group income surplus for the parent, we're also going to have a share on that, based on the percentage holding for both company or for both of them. Now, I want to draw attention to something. In this very question, we have seen that none of these net assets changed, with the exception of the retained earnings, which increased by 1,001, which has also caused the same difference. So, like I told you, if you had not done this, and you have looked straight away at the retained earnings to get your difference, in this very question, you would have been right, maybe, but you may have lost ticks for this. But you would have used the 1,001, and then it's going to give you correct answers. But in some questions, you are going to see a lot of changes. We are still moving ahead. When I finish doing the intra-group adjustment, we are going to pick a question that is more loaded with additional information. And then you will see that a lot of these may change. Okay, so you can see even there could be an issue of share. There could be a change in revaluation. There could be a fair value adjustment that we need to do to reflect. And all those ones are going to change the net asset. So I repeat that do not put all your hopes only on the changes that happen with retained earnings. Even though retained earnings will always change, but there could be other changes in the net asset as well. So that is it for that. So having been able to get the post-acquisition profit, the next thing we can focus on now is to calculate the goodwill at acquisition date. Then we move to other things. So working number 4. Working number 4 will be goodwill calculation at acquisition date. Let me put 3 zeros up like that. Okay, so we have the purchase consideration. We all know we begin with the purchase consideration of the parent. And we have worked that to be 1,953.60. Okay, so that is the purchase consideration. Then, remember that I told you that when there is a full fair valuation for non-controlling interest at acquisition date, we add that to the purchase consideration to get our goodwill. Now, in this question, we are told that non-controlling interest was valued at 450,000. And so, we'll add that non-controlling interest at fair value. And that is 450. Remember that 3 zeros are already up. So 450,000. And then when we add that, we are going to have 2,403.60. That is going to be the total cost of investment, okay? And then we can now take out the fair value of net asset taken over. But remember that over here, we are not going to strike any percentages because this value represents 100% of the cost of investment. So we are going to list the fair value at acquisition date. And ladies and gentlemen, the reason why I did this before going here is that it will save me time. I'm not going to list all these net assets already because I've already done that here. These assets are what I'm going to list. So I should have listed this 1,250, the revaluation surplus of 250, retained earnings of 300, and then the brand name, of course, of 250. But because I've already done that at working 3, I can just pick this total and send it straight. And it's going to save me a lot of time. So when I send it there, I'll refer the examiner that I did that at working 3. So I will say less fair value of net assets at acquisition date. And I'll say working 3. Then I'll put here 2,050 in bracket. So that straight away, I get the value of my goodwill. So it makes the goodwill calculation even simpler when you do this first before that. So that is why I intentionally did that, to teach you something. And so the goodwill value now becomes 353.6. So that is 353 Ghana cedis, 60 pesos. We are told in this question that goodwill was not impaired. So we leave it like that. If there was any impairment of goodwill, we would have taken out, we will say less impairment of that amount. And then we get a final goodwill. And that goodwill impairment would have also been taken to the group income surplus to reduce it. That is how to treat that. So ladies and gentlemen, we are done with the goodwill on acquisition date. So let us move on to the non-controlling interest and then consolidated retained earnings. But before we move on to that, there is something that I want us to look at. Very, very important. The unwinding of the discounts. Please pay attention. Now remember that on acquisition date, there was a promise to pay 600,000 in 2 years' time. And that date was 1st January. 1 year later, now, you see, the acquisition date is 1st January 2013. The 600,000 is to be paid on 1st January 2015. And that is 2 years' time. Make no mistake about that. Now we have moved to 31st December 2013, which is 1 year time. So we are left with 1 more year. Remember that this is equal to 31st December 2014. If you don't know, 1st January 2015 is the same as 31st December 2014 in accounting. So it means that there is 1 year more to go for the 600,000 to be paid. Now, on the date of acquisition, we're supposed to pay 600,000 in 2 years as a contingent deferred. But we discounted it 2 years back because we calculated the goodwill based on the date of acquisition. Now we have moved 1 year. So the value of this contingent consideration will no more be 453.6. I don't know if you understand what I'm trying to say. What I'm trying to say is that you tell someone that okay, so 1st January 2013, I promise you I'll give you 600. Okay, now this 600 will be given, let's say 1st January 2014, 1st January 2015. This 600 will be given on 1st January 2015. Anyway, I have told you that I am going to pay you 600,000 or whatever in 2 years' time. I'm promising you today, which is 1st January 2013. Now, we have said that the value of this 600 in 2 years' time, discounted back to today's terms, is 453.60. Now, pay attention very well. This 600 I'm going to pay on 1st January 2015. As at 1st January 2013, the value is 453. Now, today we are standing here. 1st January 2014 is the same as 31st December. This is the reporting date that we are working with now. So, previous year, this 600 was valued at 453. In 2 years' time, it will be valued at 600. What is the value in today's terms? We don't know. And this is what we need to show as our liability for the statement of financial position, because it will be shown as a contingent liability. It should be shown as a contingent liability. Now, please take note that, I repeat, we are going to pay 600 in 2 years' time. In today's term, the value is this, as at the date of acquisition. But at reporting date, we need to show this 600 in our statement of financial position as a liability. At what value? Because we cannot show it as 600. 600 will be the value in 1 year time, because where we are standing today, we have 1 year more to go. Then in the previous 1 year, it was 453. So what is the current year now? So now we need to discount it again, because from here till the date that we are going to take it is 1 year. So we now have to discount it and say that it's now 600 times 1 over 1.15 raised to the power 1. This time it will not be raised to the power 2. So that this will be the new value for this year. So when we discount it to this year, the new value that we are going to get, I'm going to show you something called an unwinding of a discount. So this is going to give us 522. Okay, so previously we discounted 600 times 1 over 1.15 raised to the power 2, because we're looking at 2 years forward. And we had 453.60. Now we discounted it 1 year and we have 522. So if you are going to show this, the difference between this new value and the previous value is called an unwinding of a discount. We have brought back the discount. Let me take my time and explain this for you. It's very important for me. Now, we are supposed to pay 600,000. Watch this very well. We are supposed to pay 600,000. And so, currently, we pay it in 1 year time. So once we are going to pay in 1 year time, we are so going to say that the contingent consideration, or the contingent consideration as at today, is supposed to be 600 times 1 over 1.15, which is as for the discounting formula we all know, raised to the power 1. Raised to the power 1 because it's going to be paid in 1 year time, because it's no more 2 years time. We have moved from the date of acquisition. So where we are standing now, we have 1 year left. So in 1 year time, we are going to pay 522. Then in the previous year, or at acquisition date, we discounted it as 600, 1 over 1.15 raised to the power 2, and then we had 453.60. Now, you see that we are moving closer and closer towards 600. So next year, when we discount it on the date that we are supposed to pay, it's going to be, let's say, 600 times 1 over 1.15 raised to the power 0, because now we are in the current year. And any number raised to the power 0 is 1. So it will be 1 over 1 times 600, which is still going to be 600. So in next year, whether we are discounting or not, it now comes back to the same value. So we are saying that as we move forward year after year, we move forward closer towards the 600. And so what I'm trying to say is that we have moved from 45360 to 552 now. And so let us subtract and find the difference. The difference is going to be 68.4. This 68.4, we have to treat it as an additional finance cost. We call it the unwinding of the discount. We discounted it forward and it gave us a small amount. Now we are unwinding it towards 600 and it has been unwinded by 1 more year. And so 68.4 becomes a discount unwound. We call it discount unwound. That becomes an unwinding of the previous discount. The previous discount took us to 453, but it has been unwinded to 522. Next year, there will be another unwinding that will take us to 600. So all that I'm trying to explain to you is that once you get the purchase or the deferred consideration to find your goodwill, at the date of reporting, find another new value using the time value of money, and then compare the discount value that you had at the date of acquisition to the current value. The difference will be a finance cost. We call it discount unwound. So this is how we are going to treat it. This discount unwound will be subtracted from the group income surplus because it's a finance cost. It's going to affect our profit. And then we are going to treat the new 522 as our contingent liability in the consolidated statement of financial position. So I'll call this also as working 5. Okay. All right, so having understood the unwinding of the discount, let us also look at the last 2 things we are supposed to do. That is the group income surplus and then the NCI at reporting date. So working 6, let me call it group income surplus or consolidated retained earnings. And we said that the group income surplus, let me put my 3 zeros up. The group income surplus is the income surplus of the parent company. So parent company. And the income surplus of the parent company was 1,300 according to the statement of financial position. And then we add their share of the post-acquisition profit. So share of post-acquisition profit. And the post-acquisition profit, we got that from the net asset list, which is 1,100. So this 1,100 times 80%. This 80% is the percentage holding of the parent company. So 80% of 1,001 will be 880. Then we will have to subtract the discount unwound. Very, very important. Discount unwound, which is 68.4. Now, if there was any goodwill impairment, we would have subtracted the goodwill impairment as well. So take note. But in this case, these are the only 3 things that we are going to consider with the group income surplus. And so the group income surplus is going to be 2,111.60. Remember, there's still 3 zeros up. So this is how to get the group or the consolidated retained earnings. And then finally, let's look at the non-controlling interest value at reporting date. So non-controlling interest at reporting date. This is also group income surplus at reporting date. The same thing. So let me show my currency sign as well, 3 zeros up. And that is going to be, now listen, previously I told you that the stated capital and the pre-acquisition profit is going to be eliminated when we have the fair valuation of NCI. It will replace that. So we will start with the NCI at fair value, which we were given and we used to calculate the goodwill. That will come first. And then we give them their share in the post-acquisition profit, and then we are done. So we'll say that NCI at fair value at acquisition date, that is 450. And then we'll say their share of post-acquisition profits, which is 20% of 1,100 that we had from the net asset list. So that is going to be 220. And so when we add 450 to 220, that gives us 670. Remember that in all this, there are 3 zeros up the currency sign. So this is how to go by the non-controlling interest at reporting date. So you see that we are gradually moving. This question is still not complete because to get a very complex and full question with this, we need to talk about the intra-group adjustment and maybe fair value adjustment. But we already have 7 workings. But because we moved step by step to this place from where we started, I'm sure that if you have been following all this while, you shouldn't be lost at this point. We are now going to prepare the consolidated statement of financial position, and that will end this video. All right. So we'll start by saying GBL group. Consolidated statement of financial position. As at 31st December 2013. Let me bring my 3 zeros up and then let me show my notes where necessary. So this is the consolidated statement of financial position, as easy as ABC. So we begin with non-current assets. We are not going to waste time with this because we have explained into detail every other thing that should be done. So there was property, plant, and equipment, which we have for the parent was 2005, and then the subsidiary was 2000. There are 3 zeros up. So that gives us 4,500. And then remember there was goodwill. The investment or the purchase consideration up down there will not come. That is the 1.5 million, we won't bring it. So the goodwill was from working 3. It's either you put here working 3 or you put under notes 3. Very, very important. I think the note is a more professional way of doing it. So note 3. And the goodwill value is 453.6. So the notes that I have put here is there to cater for the workings. So please take note. Note 3 means working 3. I could have put into bracket W3, but I'm saying 3 under note so that you know that this is from working 3. Sorry, the value is 353.60 for goodwill. And then there was another intangible asset, the brand name which they introduced. So brand name, and the brand name is 250. So to give us the total value of the non-current assets as 5,103.60. Okay, and then we move to current assets. Current assets, we have inventories. Now, the inventories were 150 for parent, 400 for subsidiary. And remember that I told you that the goods in transit of 100 will also be treated as part of the inventory. So plus 100. So the total is going to be 650, if I'm right. Yes. So the parent company's inventory, the subsidiaries, and then the inventory, which are goods in transit. This is still part of inventories of the group, whether it's in transit or not. So we put that there. And then we have receivables. The value of receivables per the question. We have 800 for the parent, 350 for the subsidiary. So 800 plus 350. And that is going to give us 1,150 for inventories. And then we move on to the next item, which is going to be, I think, just because the owings to GBL and owing, whatever, the owings and then owings by GBL and then the owings to ABL has cancelled out. And that is why we have the goods in transit. So let's bring our cash and cash equivalents. And then the cash and cash equivalent is just 100 for the parent, nothing for the subsidiary. So that gives us a total non-current asset of 1,900. Okay, and so we add the two, current assets and then the non-current asset gives us our total assets. So total asset becomes 7,003.60. So that is it for the total assets. And then we move on to equity and liabilities. But we are going to start with equity. In this question, I didn't see any non-current liabilities. So we'll start with equity. So it's going to be only the current liabilities. For the equity, I told you that the stated capital will be that of the parent company only. Same with the revaluation surplus. It's going to be that of the parent company only. So the stated capital for the parent company was 2,250,000. So that is 2,250. And the revaluation surplus for the parent company is 600. In fact, when it comes to the items of equity, apart from the group income surplus that we did workings, almost every other thing is that of the parent company alone. So we do this. And then we can add the consolidated retained earnings or the group income surplus, because that is part of equity. And the group income surplus per the working we did was 2,111.60. And so when we add, it's going to give us the value of equity to be 4,961.60. So this is the value of equity. And then we can now add our non-controlling interest. The group income surplus, I think, is from working 6 or so. The non-controlling interest is from working 7. And that is going to be 670. So when we add these two, so this is what we do all the time. We get the value of equity for the group, and then we add that of the non-controlling interest. And when we add the non-controlling interest value to this, it's going to be 5,631.60. That is it for the equity and the non-controlling interest. And then we can now add our liabilities. I don't have space down here, so I'm going to continue from this side. So I'll start with now. If there were long-term liabilities, I would have brought down before the current liabilities, but there are no long-term liabilities, so I move straight to current liabilities. Now, the reason why there are no long-term liabilities, I'm going to explain to you. You see those contingent consideration, okay, would have been a long-term liability. But from where we are standing now, the 522, we have just 1 year to pay. So any debt that you have 1 year to pay is a current liability. But if it was 2 years to come, it would have been a non-current liability or a long-term liability. So we begin with our trade payables. Per the question, there are trade payables. The trade payables for the parent is 500 and the subsidiary is 350. So we have 500 plus 350. And that gives us 850. And then we have the contingent consideration, which is a contingent liability. The contingent consideration is also coming from working 5. So let me put notes here. Note 5. And that is 522. So when we add the 2, it's going to give us 1,372. So now, this is total liabilities, total equity. So when we add the 2, it should give us what we call total equity and liabilities. And that is going to be, if you add these two, you are going to have 7,003.60. And so, ladies and gentlemen, this figure for total equity and liabilities is the same figure for total assets. And therefore, there has been a balance for our statement of financial, for our consolidated statement of financial position. Okay. It has been a long video, but I took my time to explain. I could have made it short by going faster, but I believe that your understanding is the most important thing, and you've really been able to grab this concept well. Now, in our next video, we are going to look at intra-group adjustments. We are going to look at a situation where parent sells inventories to subsidiaries or subsidiaries sells inventories to parent. How to treat it, especially in a case where they are unrealized profits. How to treat them in the consolidated statement of financial position. And then also we are going to look at transfer of non-current assets. Okay, we will look at fair value adjustments, and then we will take a question. Now, Remember to subscribe to this channel if you are new. Share this video, recommend this channel to other accounting students who are also struggling to also get a benefit. And together we'll be successful. Until we meet again another time for the video on intra-group adjustment. It is bye for now.